Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffery, your host today. I'm here with Damian McIntyre and John Mosko from Federated Hermes. Our topic today is called Talking Tariffs, Current Status and Investment Products. I want to welcome Damian and John to the podcast. Welcome.
Pleasure to be here. Thank you.
Hey, Craig. Good to be here as well.
I'm not sure how many podcasts we've done, John, but it's been a few, and Damian, it's good to have you on. So let's get started about talking tariffs. Tariffs are still an issue in the news. There's court cases. There's all kinds of things going on. I'd like to start, and Damian, I'll ask you this one first, about the current situation and the broader impact of U.S. tariffs. How would you describe the current situation, and what are some of the reasons you see for turmoil, progress, and anything else?
Yes, we kind of hit a steady state with tariffs for a while there. We had Liberation Day, and then we had the pause, and then we had the July tariffs, and everything kind of went into the background. But what wasn't going into the background was the court cases. So the Trump administration, they used the IEEPA, a lot of people call it IEEPA for short, ruling that gives them emergency economic powers to impose sanctions and other things on foreign countries in the event of an emergency. That was challenged in the courts, and that's been going on in the background as we've been muddling along throughout this whole year this year, thinking, will the Fed cut rates? Will they not? And most recently, we just got a ruling from a federal appeals court. They ruled against the government in a, I believe, 7-4 vote. The key thing here, though, is that they stayed the tariffs. So they said that the government can continue to collect tariffs, even though they said they don't think the IEEPA authority gives the right to have tariffs. But ultimately, this will probably go to the Supreme Court. So we'll be dealing with court cases on these tariffs for at least another 3 to 10 more months, depending on how quickly the Supreme Court picks it up.
Interesting. Just a question on it too. So you mentioned the everything from Liberation Day forward. Is some of the news of India and China related to fuel from Russia and Iran? Does that become a bigger issue of late? It seems like it's in the news more.
Yes, they had their summit this past weekend, and so there was a lot of photo opportunities of Modi and Putin and Xi all laughing and holding hands, walking throughout China. But yes, that's one of the big topics that's going on right now, especially if you follow Trump's Truth social account. He's been tweeting up a storm there about the three friends getting together. One of the things he has done is he has increased some tariffs recently on India. Again, this is using the IEEPA authority, so whether it stays permanent is up to the courts. But even if it doesn't, there are a lot of options that the Trump administration would have should the Supreme Court shut down the IEEPA tariffs. So that is something that people should definitely have in the back of their head going forward into 2026.
John, I didn't know if you wanted to weigh in on any of the reasons and rationale. There's certainly a number of rationales that have been put forth by the administration.
Well, I agree with Damian in the sense that I think that, say what you want about the current president, I think he's been very transparent in the sense that he's wanted to make this part of his foreign policy, in terms of being fair and trying to level set between countries, whether it's inequities among tariffs or inequities around NATO budgeting. The transparency's been there, and I think the question becomes, what are the effects? And if you were to see today's employment report, we're talking now first in September, since we're a podcast, the August employment report is starting to finally show some cracks in the employment and non-farm payroll. So could that be directly related to small businesses pulling back? I think Damian would have a better sense of that. But to the extent that the president has said that he wanted to sort of level the playing field, we're just seeing that in action.
Yeah, that was certainly one point that we've heard different times. The other thing that's been talked around a little bit, neither of you could comment on this, is part of this is raising the tariffs. I guess the External Revenue Service of paying for the big, beautiful bill. Any thoughts on that? I don't know how much that's expected to increase that type of revenue. I think 400 billion is a number I've heard. Any clarity on that or perspective?
Yeah, the Trump administration views it as a way to pay for the one big beautiful bill. And obviously treasury markets over the past couple of months, especially when the bill was going through Congress, had issues with the deficit levels that were coming with that bill. So 400 billion per year for 10 years, that's $4 trillion added to our already $37 trillion government deficit, which is just massive numbers. When you start counting out every single one of those zeros. My daughter's doing middle school math right now. They're actually doing scientific notation, and she has to write out like 10 to the eighth power and all the zeros. And it's like, that isn't even our government deficit yet. Like, keep adding a few more and you'll get there. So it is a lot, but at the same time, we import something about $4 trillion worth of goods every year. So if you were to slap a 10% tariff on everything, there's your pay for. And that's what the Trump administration's looking at. Now, obviously, there's carve-outs, and it's not every country. So we're seeing tariff levels higher than that everywhere. I believe it's 15% as a default on most countries. And then you have specific countries like Switzerland at 39%, China at 30%. The UK, I forget what they got. I think it was somewhere around 20% for their negotiated tariffs. So overall, the Trump administration believes, and we're already seeing some of the fund flows, that this could be a pay for the one big beautiful bill.
Interesting. Well, why don't we just spend a moment, maybe Damian, I will start with you. Maybe give me a quick overview of Federated and your background, your role at Federated, and then we'll jump to John after that.
All right. Well, I'll give my background on me, and then John can give a perfect summary of Federated. He's been doing it for however many years, so he's eloquent at it. So I'll let him do the Federated intro. But for me specifically, I am Damian McIntyre. I am the head of multi-asset solutions here at Federated Investors. I'm also a senior portfolio manager. Been working at Federated for a little over 17 years now. Joined the firm right before the breaking of the buck in the 2008 from the reserve fund. So it was a perfect time to join an investment manager that has a lot of its assets in money market funds, But it's been a lot of fun to be here at Federated. We touch on a lot of topics from money markets to equities to fixed income all across the globe. So it's been a blast working at Federated. So John, why don't you introduce the firm and yourself?
Sure. Thanks, Damian. Well, I'm your older twin brother because I started in May of 2008. And exactly at the time, as you pointed out, when liquidity assets were becoming, well, they are what they are. But to that end, I oversee liquidity sales in North America for Federated Hermes. We're located in Pittsburgh, Pennsylvania, but we have a global footprint. And as of the end of the second quarter, we oversee $846 billion, of which 634 are money market assets.
Thanks for the intros and the overview of Federated Hermes. I think we have a link for Federated Hermes in the show notes for anybody wanting to click through. I'll get back to you, Damian, or start with you on what are the possible outcomes of the tariffs, some of the responses to the tariffs. Maybe you could talk us through the major potentialities.
Yeah, so with the court case this past week, right before Labor Day weekend, one of the things that people started thinking was maybe tariffs will completely go away and then this will be all in the rearview mirror someday. One thing to think about is the Trump administration, they're using one particular trade law, the IEEPA law. There are so many different trade sections that they can utilize. One of the sections that the Trump administration will certainly be looking at is in case they get overruled by the Supreme Court would be Section 122. So that allows the president to impose up to 15% tariffs or quantitative restrictions for up to 150 days on any country that they view they have a balance of payment issue with. So the reason that's important is if IEEPA gets overruled, they would then look to do the 301 tariffs like they did on China in 2018. Those involve investigations, research papers. It takes time to put those together. So you kind of have a stopgap measure with the 122 to then implement the 301 tariffs. So all sorts of numbers thrown out, but the main takeaway is tariffs are here to stay. we're likely going to have a one-time price increase. You'll see it in CPI. We're already starting to see it in CPI. But we believe at Federated Hermes, and Jerome Powell at the Federal Reserve has also said they believe it will be a one-time price increase and then a transitory, pardon that word, return back down to lower prices. So overall, that's why the Fed is kind of looking through it and instead looking at the economy and the jobs market. But yeah, tariffs are here to stay. One-time price increase, unfortunately, for all of us Americans.
So there's a step up, so it's not ongoing inflationary. Will prices generally, they slowly increase? Will it just go back to that slow increase, or will there be a decline?
Correct. It will be a one-time pop and then continue its slow increase because once a company rolls down a new price, they're never going to go back to that lower price. They know their clients and their consumers will pay a little bit more for a can of soup or a car, whatever they're buying in between those two. So if they can get away with a higher price, they're going to take it, even if their costs do go down in the future. So the way to think about it is kind of finding a new plateau and then growing from that higher plateau in terms of prices.
As we see, or when we see that one-time price change, is that going to give the Federal Reserve more ammo on their dual mandate to lower rates? What are we expecting?
So the Federal Reserve right now, they're a little bit nervous that it could become sticky. So companies raise their prices one time and then they get greedy, and instead of raising their prices at 2% going forward, they say, yeah, well, why don't we try 3 or 4 or 5%? So that's the fear that the Federal Reserve is looking at. That's why Jerome Powell has kind of been dragging his feet through this jobs market over the summer. So he's afraid of the stickiness potential of that one-time price increase. But what he said at Jackson Hole, and is probably even more true today following the non-farm payroll report that John mentioned earlier, is that with the labor market the way it is and the economy kind of sputtering along here, the ability for companies to continue to push on price isn't as strong of a case as it had been in the past. So if you're, barely hiring people, or, God forbid, jobs start declining month over month, companies aren't going to be able to say, hey, let's raise prices, because then they'll just lose consumers. People will stop shopping there, and we'll start to be talking about the big R word for GDP.
John, any feedback on that, or other comments there, or I don't know, you may want to discuss, is there a different impact between the end consumer, small business, or large business?
Yeah, it's an interesting dynamic that Damian presents, Craig. I think that not being necessarily on the forecasting and investing part of our company, but more in the distribution side, and maybe don't take as analytical a view as I could or should. I tend to be more empirical. And so when I look around my neighborhood and I still see help wanted signs, and I still see construction vans, and, talking to local neighbors or people that are doing things, and still the difficulties in finding people to do work, maybe, yes, is there a slowdown going on? Absolutely. Are tariffs to blame and inflation to blame? Probably. But I'm not as convinced that we're headed straight down. I think we've had a very long stretch of robust growth, and post-COVID especially. And I think that I see help wanted signs still in the local supermarket or air conditioning people. And I think the economy's going along. And I know people talk about the tale of two economies, right? The upper echelon high earners versus sort of people that are working 2 and 3 jobs just to cover their basic necessities. So I understand that part. And I think that's probably where it's hurting people. So I accept that part. And, I guess we're going to pivot in towards Fed views in this. So I'm not of the camp that the Fed needs to be aggressive, but I do think we probably are working our way into that trajectory of lower interest rates over time, starting with the mid-September Fed meeting.
Yeah, thanks, John. Damian, any additional thoughts on the Fed's going to lower rates almost for sure, not aggressively like John is suggesting, or more aggressively or systematic, or what should we be looking for there?
I think the Federal Reserve will want to be systematic with how they approach it. So I think they'll start a pace and try to maintain that pace until the data tells them otherwise. So we're likely to get a 25 basis point cut in September. Their next meeting, I believe, is in late October, and then they have one in December. So the data gets materially worse, maybe then you start to talk about aggressive and maybe October comes into play. But I would probably say my default base case would be they skip October, then they go in December, skip the next meeting, and then go in the following one, and so on and so forth, until they get down to about the 3% level. And the reason it's 3% is that's their neutral rate. So if you're above your neutral rate, you're in restrictive territory. So if we're talking about barely adding jobs and some concerns about spending or consumer attitudes and what tariffs might do to the economy, it doesn't necessarily make sense to be very far into the restrictive territory. So I think that's what Jerome Powell is going to come to realize, is maybe we can be less restrictive over time and gently glide into your neutral rate probably by the end of next year. And they'll just kind of take a measured approach and a systematic approach and say, okay, every other meeting for the next 12 meetings or however long it takes them to do it. And then they'll pause once we get to neutral, unless economic data has materially changed by then. I mean, that's frankly 15 to 18 months from now. So it probably will have changed by then.
Right after Tariff Independence Day, I think there was a lot of perspectives that we were going to go into a recession, or there'd be steep inflation as well, maybe combined with that. Has that shown up significantly? I know people have talked about maybe it's delayed. Is it just different than most of us were expecting right at the outset?
Things certainly got scary there for about a week after that Liberation Day. And then we got the famous Trump blink, whatever you want to call it. I think it was called Taco on Twitter. Trump always chickens out, taco trade. But on April 9th, just a week after Liberation Day, he said, okay, we're going to pause everything for 90 days. That gave companies a lot of opportunity to front load inventory and load up on stuff ahead of the tariff levels. So what we're starting to see is the data is showing up in inflation slowly at this point, as companies work through those inventory levels that didn't have tariffs and having to place new orders that do have tariffs. But overall, if you think about our economy, in your basket of goods, frankly, shelter is 33% and food is another 10%. There isn't too much that we're importing directly, furniture or clothing or stuff. So it ends up being a little bit smaller than what your gut reaction would be. You hear 15% tariff and you think prices are going to go up 15%, but it's only going up 15% on a select portion of your goods. So it ended up being a lot smaller than I think originally people were expecting.
I guess if our economy is about 28 trillion roughly, and our imports are 4 trillion, I think is what you mentioned, that by itself is 14%. So 10% on that would be 1.4%.
Exactly. And then not... At least the math's right. Yeah, the math is right. And not everybody's going to put forth 100% of their tariff costs either. Some of them might say, oh, we can only afford to put forth half of that in price increases. So yeah, it starts to be much smaller. And now we're talking 1%. Is that enough to derail the Fed when they're looking at low job growth? I don't think so.
Craig, could I ask Damian a question then? So in a closed universe, right? So companies are paying tariffs. They have to decide whether they're going to forward those costs onto the consumer. They'll either choose some percentage of 0 to 100. If it's less than 100, then they're now absorbing that cost. Why, with the S&P at all-time highs, as of, I guess, yesterday, does the potential exist for that to manifest itself into earnings?
It has the potential, obviously, because we're talking higher costs without higher revenues. I think one of the things that we've learned over the past 5 years is the resiliency of American companies and their ability to be creative and to continue to drive profit growth. So it would impact their EPS overall, but maybe it ends up being a slower growth than previously expected. So they're continuing to grow earnings. They're just not growing earnings at the same clip that people thought before Liberation Day. If you look at the estimates, the consensus estimates for 2025 earnings for the S&P 500, they were a little bit above 275 pre-Liberation Day. They're at, I think, 268 the last time I checked. So they've downshifted, but we only had about $240 worth of earnings last year. So they're still growing by a substantial clip. It's just less than what was expected prior to Liberation Day. So that's a lot of the reason for the market continue to grow despite people being afraid of tariff impacts and other things in the economy.
I want to continue our discussion, shifting it to what are the implications on the investment side, investment plans, investment decisions. I know there's more business considerations related to tariffs and the overall macroeconomic outlook. But if we look at the implications there, how should we think about the way forward on the investment side? Normally, if there's a high likelihood of rates to go down, people within their parameters, within their envelope, go out a little bit longer. If they're going to go up, they pull a little shorter so you can take advantage of the shift. What should we think about from a duration perspective, maybe from asset classes generally, and then any other factors that would matter?
So one of the things to think about is not just what's happening with rate cuts. I mean, you said it perfectly, Craig. Previously, you hear rate cuts, you lengthen out your duration because the yield curve is going to shift lower. So you want as much duration as you can to benefit from, lowering interest rates. With this particular situation, we're talking rate cuts on the front end, on the short end of things. But then we're also talking inflation, impacts of economic growth, and other things on the longer end of the curve. So we've been favoring a steepener. So the idea that stuff on the shorter end of this space, so say 0 to 5 years, you would see rates going lower and following an FOMC move on that end. But the 10-year and out longer, those areas are impacted by so much more than just what the FOMC is doing. So overall, when you're thinking about the longer end, maybe you're looking at just overall yield, maybe not as much total return potential from lower rates. But on the shorter end of the space, certainly you're thinking about what happens in lower yield environments, what happens to your money market funds and how they pay interest out. And then it doesn't make sense to go out into other asset classes that are slightly longer out on the curve, your micro short area, your ultra short area, even your short term area. So that 0 to 5 year range. And we think in that area, it does make sense to look at opportunities that might be a little bit more longer on the duration space and would therefore give you the potential for higher total return should rates come down.
John, any additional things on lengthening or different assets in that 0 to 5 year period with this almost certain decrease in rates?
Sure, Craig. So from the corporate practitioner perspective, I think each corporation has their own cash flow needs, how much they keep in cash. A term that was kind of reared its head in the zero interest rate environment of bucketing. So this is my, the stuff I need to do to pay the light bills, salaries, things like that. And maybe that intermediate stage, which might be slightly longer than a money fund's duration of 60 days. And then stuff I know that I don't need for 1 to 2 years. And I think obviously the trade would have made a lot more sense a year ago. In the sort of the 2-year sector were significantly higher. And to Damian's point, maybe captured a little more total return. But it still makes sense for a portion of corporates of cash to move outside of what would be normal liquidity expectations. I think that you look at a 2-year note's around 3.5 right now, I believe. Yeah, 3.5. And then you factor in maybe some spread from a corporate. You're probably close to yielding what a money fund would yield today. However, by virtue of locking that term in from a longer maturity perspective, you'll do well and keep that interest payment and total return as rates are on the decline. I think the Fed sort of dragging their heels over the course of 2025 kept people in money market mutual funds. And I think now that we see that this is now beginning to begin, so to speak, we may see some of that extension trade.
Here's a broader question on that. If, logically it would make sense if we know rates are going to fall to lock in the longer term. You hear this type of comment on the equity side. The price of a stock or the price of equity is based on potential future earnings. So when things change, it's reflected in the price. Why isn't that also relatively quickly reflected in the price on some of these short instruments that maybe beyond the shortest instruments that are locked in, that the price can shift? Are we seeing that? Does it not shift the entire way when you're looking at some of these funds and activities?
Yeah, I'll take a swing first, Craig. I think the money market curve, or the money market, we'll call it universe of investable securities, while we would love it to be very much break-even driven in the sense of, I think the Fed will cut, as Damian points out, every other meeting, and therefore the yield curve should look like that because I can get 4.25 today and 3.75 in a month and 3.50 in 2 months after that. And we'd love for the yield curve to be priced like that. Regrettably, there's so many other factors that are going on inside the liquidity curve that are, I hate to say indifferent to price, but in a lot of times they're indifferent to price. I need to invest money because I have a interest payment on my debt on November 15th. And I really don't care what the yield is, but I need money to mature that day. So there are always extraneous factors which skew the money market yield curve. As much as we'd love it to be priced normally, it's what we live with.
I would add in as well, something we saw in the longer space in 2022 when we were looking at the opposite of impact, the Fed raising rates and what's happening there. There's a large difference between yield and yield to maturity for the longer duration vehicles. So when the yield drops, so we saw the 2-year today, it's dropped all the way down to 350. The yield on new instruments that you have in your portfolio might be getting issued at 350, but you bought previous bonds at 4 or 4.25. So those will still yield when they come to mature that percent at which you bought it at. So there will be a little bit of a difference, and that's where we talk about your total return potential versus your yield potential on them. And then one thing we didn't mention, obviously, is there is risk as you go out further out on the curve. Your money market funds are relatively risk-free, but the further you get out, who knows, we got a bad jobs report today, but maybe next month we'll get a rip-roaring jobs report and the yield jumps back to 4%. So there's certainly risk heading out the further you go on that yield curve for investments.
Thanks for that answer. Just want to hear some final thoughts on this. I mean, we've been talking about tariffs, the status and investment impacts. We've talked about the Federal Reserve. We've talked about investment implications. Any final thoughts? What should we watch out for? What should we do? Or anything else that you wanted to reemphasize or add? Let's take it from you, Damian, first.
All right. One of the things that I'm looking at right now is a Fed funds futures curve that does have a glide path into that 3% level, that long-term Fed neutral rate level. So one of the things I'm going to be watching out for is to get easier from there. You're going to have the word recession start to creep into the market. And that's something that a lot of people get a little bit scared about. And then we're back to 2022. Are we going to get a recession? Are we not? Is the rate actually going to go to 2 or 1 or who knows where? So I like to look at the economic picture as a whole and take that into consideration. So, one of the things we have right now is a consumer that is saying one thing and doing another. You see it with the soft and the hard data. A lot of the survey datas have been really dour, and then we get a retail sales report that says 0.5% month-over-month growth on spending. So we have a consumer that continues to spend as long as they're still employed. So we talked a lot about the jobs report today. It added 22,000 jobs, which sounds bad, but it still is an ad, right? We're seeing that when you take that into account with the JOLTS job openings report we got a few days ago, we're finding companies aren't letting go of workers either. So we kind of have a frozen jobs market, a consumer that's employed and spending money. So yes, things are slowing down a little bit, but they might not necessarily be going all the way into that recession territory. So we're looking at 6 cuts. I think that the bias is probably to maybe fewer than 6 cuts. But again, if the economic data starts to get worse, you'll start to hear people talking about the big R word and the recession risks. And then you could see a lot of Fed cut expectations creeping in pretty quickly.
Excellent. And John, your final thoughts.
Yeah, sure, Craig. Thank you. Not that I'm a student of history per se, but I'm always keeping an eye out for where a disproportionate amount of money is going to in a marketplace, particularly as it relates to leverage. So if you think about, If you want to go way back when they talk about Asian bonds, or now most recently with the great financial crisis, real estate and excessive lending, as to really creating a shock in the economy, I don't see it. I'm pleasantly unconcerned per se about the resiliency of our marketplace. I mean that globally. Now, does that mean we're going to get a recession? Not get a recession? Of course we will. We'll have probably some negative growth prints, but it won't be to the point of a contraction. And so I think markets will behave normally, and being responsible for a liquidity franchise at my company and distribution, I think that we'll remain resilient, and I think liquidity assets will continue to be firm as people find, as our CEO likes to say, a warm and loving home for to find money market mutual funds as a place to keep your money while you decide what to do with it.
A warm and loving home. I like it. Thank you, John. Thank you, Damian. Really appreciate it.
Thank you very much.
Thanks, Craig.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.
Views are those of Federated Securities Corp as of September 5th, 2025, and are subject to change based on market conditions and other factors. These views should not be construed as a recommendation for any specific security or sector. Bond prices are sensitive to changes in interest rates, and a rise in interest rates can cause a decline in their prices. You could lose money by investing in a mutual fund. Although some money market funds seek to preserve the value of your investment at $1 per share, they cannot guarantee they will do so. An investment in these funds is not a bank account and is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Ultra-short and other short-duration bond funds are not money market mutual funds. Some money market mutual funds attempt to maintain a stable net asset value through compliance with the relevant Securities and Exchange Commission (SEC) rules. Short-duration funds are not governed by those rules, and their shares will fluctuate in value. Due to various risks and uncertainties, actual events, results, or actual performance may differ materially from that reflected or contemplated in any forward-looking statements. Nothing contained herein may be relied upon as a guarantee or representation as to the future. Although the information provided in this podcast has been obtained from sources which Federated Hermes believes to be reliable, it does not guarantee accuracy of such information, and such information may be incomplete or condensed. Federated Hermes is not affiliated with Strategic Treasurer.